Hello, this is Steve Lentz with Discover Options and OptionVue. Welcome to this presentation of Understanding OptionVue's Expected Return Figure. Today is October 15th, 2012, and presented material today is for educational purposes only and should not be construed as personalized financial advice. Folks, what we're talking about today is a tool that can help you understand what an option trade should return to you on average. Have you ever wondered, uh, is this option trade any good? I might be bullish. You might be bullish on a stock. So what do? You go and buy call options, right? Well, what is the amount on average that you can expect to get as a profit for your time and effort in determining that particular trade? How much can you make? In one single return figure, OptionVue can show you on average what you can make on any given trade, long calls, long puts, or any spread. And that's what we're going to explore today is this one figure. Now, before we get to that, I want to make sure you know that here at OptionVue we have an educational arm called Discover Options. We focus here exclusively on the one-on-one mentoring relationship. We have a great staff of professional option traders trading their own account and accounts of other folks as well. And on the side then, they mentor traders wanting to take it to a new level, become advanced options traders. We have 3 different curriculums plus a futures curriculum, levels 1, 2, and 3, 3 being the most advanced, and that consists of the non-directional type approaches, condors, butterflies, calendar spreads, etc. Now, amongst those strategies in level 3, I'm showing you here a table of the monthly yield levels that we have on an ongoing basis. Every month I get together with our students and we go over the rules and how well those trading rules would have done in that month. And we have a hypothetical account that we trade. And we adhere strictly to the same rules every month. Every student varies a little bit in the way that they apply the principles and the rules. Some are money managers with the clientele wanting much more conservative variances in their yield levels, for example. Okay, others really want a more liberal approach and they want to go for the double-digit monthly yield levels every time. But using a consistent set of rules, these are the monthly yield levels for each of those 2 strategies, 1 and 2. And this is based on the amount of margin required. And so you'll see some months are double-digit yield levels. You can lose 2 months in a row occasionally, you'll see there. And you'll notice that in general, you're not going to triple your money in a month or anything like that. It's a good way to grind out some decent returns month after month, year after year. And if this is anything in the ballpark of what you're looking for yourself, well then by all means, give us a call. We'd love to hear from you and we can explore with you whether what we offer is a good match for where you're at right now. Okay, let's go to expected return. We're going to explore 2 types of expected return, a bell curve approach to determining expected return, or ER, and a target-based expected return. We're going to then show you also how to use Trade Finder to compare trades using expected return and determine which trade is the best one. All right, so without further ado, let's go here. And there we go. We have a chart of Google. Now look, I'm going to show you 2 examples today. I'm going to show you one from 2007 only because back then I did a presentation where I used a spreadsheet and all these calculations and everything, and it certainly applies to today. And then I'm going to show you one from just last night on Google. Okay, we're going to use the closing prices in Trade Finder to find the best bear call spread if you're bearish on Google right now. Okay, so here's the first example we're using to look at this. Now what we do is we take the price chart, we cast it forward into the future, and I'm showing you a bell curve there, and what we do is we take 11 data points evenly distributed over 2 standard deviations. And then let me get a little highlighter thing here. Okay, I'm going to draw right down here. This is the important part. We're looking at the expected return over a bell curve, or what we call a normal distribution. Expected return is the sum of all 11 evenly distributed possible outcomes after weighting each outcome by its probability of occurring. See that? So, let's say that you bought a long call option, and then you look over here at when it expires in the October expiration, and on that long call option, if price goes down to 500, in this case, right there I'm showing you, well, you're going to lose pretty much, all the money you put into that call option, right? And if it goes down to this data point, well, you'll probably lose all that money as well. And so what we do is we look at each of these 11 data points, we multiply each one by its probability of occurring, we sum all those together to get one expected return number, which is going to be inclusive of all 11 of these data points. And so when we can flip it over, let me show you how we do that. Let me see here. I'm going to hit, where's the thing I click? Okay, there we go, perfect. Go to the next screen. There, I'm flipping it over so that now we can see here these 11 data points. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. Outcome A and B. Here's one outcome over here on this edge. We would lose all our money, all $1,680 it took to get into this trade. We would lose all of it right there if Google went down to near 500 or so, right? Okay, well, in that case, it's a little past 500. Okay, so now when you take each one of these, multiply each one by its probability of occurring and add all that together, look, the expected return is a minus number, 680 minus 680. No big surprise. No big surprise. Most of these outcomes were in the negative area. A couple of them were positive, and sure, a couple of them were way, pretty darn high there. But when you take all of them and add them together, with that probability of occurring thrown in, it's a negative figure. There is a negative expectation. A negative expectation here. All right? Okay. So, with that information now, let me show you, okay? Let me show you, okay, what did I do here? I have to hit escape. There we go. Sorry about that. There we go. Let's show you another target type. This is very, very similar. Okay. I'm just going to kind of show you, well, it's somewhat similar, but I want to just show you how it's calculated in terms of your target. What I showed you was a bell curve random target. Okay, it's no big surprise that this loses, because if for you to make money on a call option, you need the underlying asset to move up quick. All right, randomly, the market's going to also go down and chop around, and you lose money in both scenarios. The only way a long call makes money is if the underlying asset moves up at a pretty fast pace. That's really about the only way you can have a positive expectancy of making money there. If you take a normal distribution inclusive of the downside, long calls and long puts have a negative expectation, for return there. Now, let's take our own strategy. Let's take our own target. That was the bell curve approach, putting on a different cap. We are now going to assign a target to Google rather than having, okay, let me just kind of, not to belabor the point, but yeah, maybe to belabor it. Rather than having just a random bell curve, all right, instead, we're going to go ahead and assign a target here, 524 to 560. We think Google's going to keep going up, closer to 560 on the upside. At minimum, it'll chop around and maybe go down a little bit. All right, now let's take a long call position and see how that does. As of expiration date, okay, let's just take our expiration target date. Probably not going to do very well, right? Okay, we're going in the future to that expiration date, and we have 11 outcomes. This one, each one of these 11 data points. There, you see that? And we're up here. This is the expected return. Again, this is from software from 2007. We've changed OptionVue a little bit. I'm going to show you in a second where we put this number now. Minus 1,080. Here's the deviation, 746. And what I'm going to show you now is how we came up with that number. Okay, look at this. I took an Excel spreadsheet. You're going to love this. And I inputted all of it. I said, you know what? Let me just pencil this out myself. And just to confirm the software's calculations. That was my desire here. So I took all 11 outcomes. Okay. And I averaged them all together. And I took the standard deviation of those. And this is in Excel. I took the standard deviation calculation right there. Minus 1080, 746 standard deviation. See that? Okay. And that's what you get up here in the top right corner. That's the expected return and the deviation there as of 32 days, where that previous target was right there. Okay, so if we went long a call option, you know what? It's not going up fast enough. That target is not bullish enough to really give us a good a positive expected return. It kind of shows you that long calls may not be all they're cracked up to be, right? All right, that's why we really like option spreads. But now I want to show you a different target type. A different target type. Look, your target, your stop loss could get hit before that that expiration date in the future, right? So if you have a stop loss, it could be hit tomorrow, it could be hit 5 days in the future, 10 days, we don't know. That's why having a date range might be a good way to implement a more accurate target for yourself in calculating an expected return. So in OptionVue, in the price charts, there is a target box that you can create. And this corresponds to, well, let's see here. This corresponds right there. Okay, and you can kind of see 524 to 560, September 18th to October 20th. All right. And here's how we calculate a new expected return. This expected return is done completely different. We take 11 data points, but look at this. We do it for 5 different time frames over the width of this date range. So we're always going to take one, on the near date, on the far date, and on 3 equidistant time frames in between. And it'll round in case there's an odd days or something like that. But it's going to take 3 equidistant time frames, and it's going to run this 11 data point calculation in each one of these time frames in the future. For today, the far date, and then 3 different ones equidistantly distributed. Okay? And then it comes up with this calculation, minus 315, 899. Now let me show you the spreadsheet that did this. It's pretty cool. There we go. And I just ran this myself. I wanted to confirm the software's calculations, and it penciled out to the very dollar. Look at this. I took the today, T plus 0. I ran this thing. I inputted all the theoretical calculations from OptionVue, came up with that average. I did it for, of course, the one in the distant future in the expiration, the one we just saw. I did it for each of these other 3 dates, and when I then put in the average of all 5 of those averages, here's what I got: minus 315, 899 deviation. Pretty amazing, huh? Look at that. Came out right exactly. Just pegged it right there. Just pegged it. Okay? So that's how it comes up with an expected return over the course of a date range. A date range. Okay? So, given that, let me show you now how we can apply this to an example more currently. I'm going to, just a second, let me take a quick break here. Let's see here. Okay. We are looking at a new target for Google as of last night's data. Let's say that you thought Google was going to top and you wanted to put on a bearish trade. Let's say you thought about a bear call spread. And you thought that this was a good target box. If Google did go up, it would take a few days to then ascend above the previous high. If it went down, okay, it could go down to around the 700 mark, either real quick or sometime in this little 2-week period or so. Right, well, it's about a week and a half period right there. All right, here's the numbers there. The high of 775, a low of 700. The date for this closer line here, 10/19, moving out to November 1st. That would be our target box. All right, what you can do is in OptionVue, you would go to your Google matrix, make sure there's good data in your Google matrix first, then you go to Trade Finder. To go to Trade Finder, you click on the Trade Finder button. But look, don't click that until after you have good data in your Google matrix. Make sure you have good data there, then click Trade Finder. Then you can go in here and input your target. And here's our target that I just showed you. See that? All right. Then we click on the Strategies tab. Right there, we go to Strategies. Okay. There we go. And under Strategies, you have all these different strategies to choose from. You know, for our purposes, I'm selecting one strategy, just a credit spread. I want to do it only in the calls because I know I'm bearish. You could certainly select other strategies. Sometimes it'll find, ones that are, very interesting. Maybe you certainly didn't think of it. But once you go ahead and do this, just put a check mark next to the strategies you want, etc. And then you click on the Goals tab. All right, let's go to Goals. I'm just going to put 3,000 into this trade. And I could show you this. You can include an existing position in your analysis. All right, just make sure that the capital provided covers the cost of your existing position plus additional capital to put on something else on top of it. All right, and this is the kicker. If you're going to use Trade Finder to try and repair a position you have right now, typically you're going to have to add more money to your position to then bring it into having a possibility of a positive outcome. So keep that in mind when you include existing positions. Your capital provided is going to have to cover quite a bit. That existing position plus anything that you're going to add to it to make a possibility of a positive expected return. Look, if there is no positive expected return, it has to be greater than 0, okay, for it to appear in Trade Finder. If it's not above 0, it won't even show up. It'll say no results. No results. Okie dokie. All right. Let's go to filters now. In the filter screen, you can, I like to use this. I like to use a minimum price to sell. I don't want it really showing me the 10-cent option to sell because it's, mispriced by a few cents, and it's going to have me load up on it. I do use always commissions and slippage when I run Trade Finder. I want those kind of goofy situations to be kind of removed. But another thing too, and a lot of people, suggested this, is right here, this filter right here. Look, if you have a target that's only 5 days out, you really don't want OptionVue showing you the, those trades that are 5 months away for you to, go long calls on this, on this mispriced option in the 5th month kind of a thing. Now, if you want that, well, then go ahead and not have anything in here. Okay? Otherwise, go ahead and use this filter. Now, keep in mind that filter will stay for all Trade Finder runs that you do unless you come into filters and change this. All right, now, whoops, skip screens. What I did here, filters, filters. We now click the go button. We click the go button, and we end up then down here with some results. See that? Now, I'm going to rank these results. I'm going to show you that we should rank them by expected return, and then I like this one here, expected divided by worst case return. Expected divided by worst case return. Let's look at this one. I'm going to, those that have the highest expected return pop up at the top of the list, beginning with this one. Here is a bear call spread in Google. See that? And notice that its expected return is at 263. It's higher than all the others. Than all the other bear call spreads in months expiring in 90 days or less. What I'm going to do is highlight that trade, number one, hit the Analyze button, and when I do, it brings up this screen right here. Graphic analysis screen, just to show you a few things. Notice here on the left, target results, expected return of 263. That's just what we saw over in Trade Finder. You see that? Notice that here's the target is shaded. We did have a date range to it. It's only showing 3 of the 5 date ranges that were examined in coming up with that 263. We could raise the number of lines up to 5 if you wanted to see all 5 of those time frames. All right, but we can clearly make money if the market moves down. We would clearly lose money if the market moves up. But all in all, over the course of those time frames, this is the trade that does best on average. Now, let's go back. I want to show you another way to rank this. You may not be impressed with that trade, and I'm not either. Here's what I like to do. I like to come here to the way that we rank this as ratio of expected to worst case. So here we rank by expected is at 167. That's a little bit lower, of course, than the 263, but look at this. The worst case return out of all 5 time frames, out of all the 11 possible outcomes for each time frame, the worst case return altogether was minus 540. Now when we analyze this trade right there, we're going to go to this next screen. This is what we get. We can clearly see here on average, well, our worst case return would be this data point right there. Okay, minus 540 or so. Now, look at this though. Our expected return is at 167. Worst case is at 540. We still have a positive expected return, but our worst case return is much, much lower relative to what we can make on this thing. I think this is probably a superior way to rank the trades. And to prove it, I'm going to hit superimpose, bring in the previous trade that we just looked at, right there. And we can kind of see, yes, it's true that this, in 20 days or so, we're not going to make as much money here as the other trade could make. But look at this. On the worst case, we could lose a lot more money worst case than we could over here for ours. And so if I get stopped out on this, I want to get stopped out on one that's not going to burn me so bad relative to what it is I can make. So I think the red line, the second way of ranking, is probably the better way, ranking them by expected return divided by worst case returns. So I hope this is a tool that you can take with you and really use OptionVue better as a decision-making tool for yourself and in your trading. Also, I hope this has shown you that Trade Finder has some tools with expected return to help you sift through the possibilities and really make some better trades. Okay, just as a final reminder, if you have any inclination at all to get some options education, really want to encourage you to go to discoveroptions.com. Here's our website. You can go to the mentoring section, look at the bios of our mentors, give us a call, shoot us an email. We'd love to hear from you. Okay, take care. Have a great day.